following program is a presentation of the Options Insider Radio Network. For more programs, visit www.theoptionsinsider.com or search for Options Insider Radio in iTunes.
You wanted it, you got it. A radio program that helps teach you options trading inside and out, basic to complex. This is Options Bootcamp, brought to you by Sogo Trade, an extraordinary value in online trading. Why pay more for the same trade when Sogo Trade can deliver for less? Options commissions are just $5 per ticket and 50 cents per contract, and just $3 for stock and ETF trades. Open a new account today and receive 100 free trades. Visit www.sogotrade.com to learn more about all our free trading tools, educational resources, and other resources available to you to enhance your trading experience. Remember, options involve risk and are not suitable for all investors. For more information, please read the characteristics and risks of standardized options available at www.sogotrade.com. Now, let's get you into peak options trading shape. Here are your Options Bootcamp drill instructors, Mark Longo, Dan Passarelli, and John Critchley.
All right, everybody, welcome back to Options Bootcamp. I just love that theme. It puts me in the mood for some options boot camping. My name is Mark Longo from the optionsinsider.com, as well as the ever-expanding Options Insider Radio Network. In fact, it has expanded quite recently to include a new show with someone listeners of this program may be very familiar with. It is, of course, our Options News Rundown program hosted by one Dan Passarelli. If you like this show, if you like Dan's contributions to Options Bootcamp, then be sure to check out Options News Rundown, available at leading audio providers online near you. It's a little 5 to 10 minute rundown of all the top stories from the world of options of that day. And if I do say so myself, Dan does a mighty fine job at corralling all of those headlines for you, the listener. Speaking of Dan, he is, of course, joining me on the show today. He is wearing his black hat to my white hat, but otherwise, he's looking and sounding the same. Dan, how are things over in Market Taker Mentoring Land?
It's great. Those are complementary colors, aren't they, Mark?
Yeah, someone's got to be the good guy, you know? And someone's got to be the bad guy to make the good guy look good. So it all works out well in the end.
Things are great over here at Market Taker Mentoring. We are teaching the world options one student at a time and sometimes in big groups.
Fighting the good fight on behalf of options users everywhere. And also joining us, I'm not sure what color hat. Maybe he's more of a magenta, kind of sky blue, maybe a light pink kind of hat. He is John Critchley, the major domo over there at Sogo Trade. John, welcome back to the show, sir. Feel free to rebuke my description of your hat if you see fit.
Yeah, I mean, I don't know what kind of hat I'm wearing now, but hi, Mark. Hi, Dan. Glad to be back with all the boot campers. Wonderful weather here finally on the East Coast and ready to do some boot camping.
I think when we finally get the store going on the optionsinsider.com, we should definitely put out some official Options Bootcamp hats and perhaps some nice little shiny whistles. We can have a variety of colors. They can choose from my white hat, Dan's black hat, or John's pink/magenta hat, and then we could see who the most popular is right there. It'd be kind of a fun little test.
I do have a whistle now because I'm the head coach of my son's baseball team. So I, as a little present, I got myself a new whistle for my team. So maybe I'll bring that in next time.
There you go. You're fully equipped for the show now. Bring that in, and we can deafen all of our listeners whenever we have a point to make here on the show. All right, with the team assembled and all of our various hats in place, we're going to roll right on into our basic training segment.
All right, Boot, it's time to get in line. What you're going to do is learn. You're going to learn how options work. Do you hear me? Yes, sir! You're gonna learn options trading inside and out, basic to complex. There will be no failures, do you hear me? Yes, sir! Call in, prepare to learn. Yes, sir!
All right, and welcome to our basic training segment. If you're just joining us here on Options Bootcamp, then by all means, this is, first off, welcome. And secondly, this is the portion of the show where we walk you through some very interesting and useful basic options concepts for you, the options trader, the options customer, to employ in your options trading. And as we were sitting down today to bandy about ideas for this episode and what would be interesting and compelling for you, the retail options user, we came back to what a lot of retail options traders traditionally use options for. And that is traditionally, they use them in some conjunction with the underlying. That is primarily with stock. Most people come to the options market from the stock market. They have stock holdings in their 401k and their own individual trading account, and they want to use options to augment that stock trading in some way. So we came back to that theme again today to think of what are some interesting ways that we can use options in conjunction with stock that could really add some value for the basic retail options trader. We've hit on covered calls in the past and collars and some income strategies, some defensive strategies. Now we're taking a little bit of a different approach to the stock and options dance, the stock and options mix, if you will, and looking at some ways that you could use your trading capital much more effectively. That's really, I think, the bottom line of the first strategy we're going to go to. And the second one is how you can use options and stock to really come back from perhaps, say, a bit of a setback you may have had in your portfolio. So two very interesting, very intriguing concepts and different ways to use options in conjunction with, or indeed in lieu of stock, to achieve your trading and investing goals. We're going to kick things off with a very common, very popular, but for some reason not that well-known strategy in the basic retail investing world. And this is the simple stock replacement strategy. Now, what are we talking about? Well, this is exactly what it sounds like. This is a scenario where instead of going out and buying XYZ stock, wherever it may be trading, you instead look to use an option and buy an option as a surrogate to that stock position. It's typically executed using deep in the money calls. Remember back to our early episodes when we talked about the Greeks. Stock obviously has a delta of 1 or 100, whichever type of delta you're using. It's essentially, it moves 1-to-1 with the underlying because it is the underlying. Now, options, obviously, the delta varies depending on their level of in the moneyness or their level of overall moneyness. And the farther you get closer to the in the money options, the higher that delta is, the closer of an approximation that option is to moving 1-to-1 with the stock, which is why when we're looking at stock replacements, we tend to focus our attention on the in-the-money part of the call chain, the option chain for calls. So what do you do with this? Well, you look out at the stock, you see where it's trading, you say, this might be a little bit expensive. I want to use an option in lieu of that, and I am going to purchase this in-the-money option to do that. Now, before I go too far down this rabbit hole, I know Dan does a lot of work with his students of this type of strategy. I'm sure a lot of people come to you, Dan, asking you this exact type of question. So why don't you walk our listeners through how you execute a stock replacement strategy and perhaps give them an example and why they may want to look to do this.
There are many ways to do a stock replacement strategy, really. And I'm going to give you two of probably the most common ones and two of my favorites. For one, a leaps call purchase, an in-the-money leaps call purchase. There's some advantages and disadvantages to the in-the-money leaps call purchase.
Before you go on, we probably should define leaps again for our listeners. What Dan is just referring to is a very long-term option, a long-term equity anticipation security, if I am not correct with the acronym. So that's usually a year or more out. So just think of it as a long-term call.
Indeed. So when a trader buys an in-the-money, and I specify in-the-money and ideally deep in-the-money leaps contract, basically what the trader's doing is buying kind of a proxy for owning the underlying stock, but there is an advantage that the trader has limited risk. And the reason why the trader uses the long-term option is because the trader doesn't want the option to expire in a month or two. It's kind of, you're going to buy a call that has a year or 2 years or even up to 2.5 years in its life. So the advantage is, hey, you know what? There's limited risk. And other than that, it's pretty similar to owning a stock, with one major difference is that there's usually going to be some premium over parity paid for that leaps call. So the way an investor who's using that leaps call as a stock replacement strategy would look at that is, hey, that premium that I pay over parity, that time premium that I pay, that's the cost of having the benefit of that long call, of that proxy that gives me some limited risk. So there's number one. You mind if I go on and go into a different alternative right now?
By all means, go on, sir.
Now, a more active trader and a trader that's maybe a little bit more option savvy, knows a little bit more about them, has a little bit more experience, and is willing to put in a little bit more time, can do a different stock replacement strategy. And that is selling a 1 month in the money put. The advantages over buying the leaps call here are the trader's selling options. And so the trader might be able to benefit by selling some time premium and basically end up maybe generating a little bit of income on this trade and maybe doing a little bit better off than the trader otherwise would if the trader just simply went out and bought the stock.
Now, I assume here you're talking about an in the money, pretty deep in the money put.
Pretty deep in the money, but I like to see, I like to be a little bit greedy with it. I like to see a little bit of time premium, so I don't want to see the trader selling, a very deep in the money 100 delta option that has no time premium left. I like to see, the trader selling, maybe a 1 month 70, 80 delta option where the trader's picking up a little bit of time premium, maybe 20, 30, 40, 50 cents here or there. Now, what I think you were getting at there, Mark, is the really deep in the money ones are a lot like the stock because they have about 100 delta. When you get some of that time premium coming in, like I'm suggesting, the delta's not as big and the profit potential is limited, but if the option's 70 or 80 delta and it's that deep in the money, it's going to function a lot like the underlying stock, especially if you keep it for the full month. And, as long as the stock doesn't run off on you and, really go and, make 20, 30% during that month period, probably in the long run, you're better off doing it, taking a little bit extra time premium each month.
Now, it's interesting you mentioned the writing of the put as a stock replacement, because I don't traditionally lump those two together, yet if you think about it the way you just outlined it, which is, of course, focusing on the more in-the-money puts, then you do have a much higher probability of those puts being assigned you getting the stock. So it is in many ways a stock replacement strategy when you think of it from that sense. And I want to hit on something else you mentioned as well, Dan, before we roll on. You mentioned buying the leaps and not buying a in-the-money near-term call. I just want to call out to our listeners again. Remember, we discussed time decay and time premium and how time decay works in our earlier episodes. If you missed those episodes, I encourage you to go back and download those because we walked through how time decay is not at all a linear function. It does increase exponentially as you approach expiration. So if you're thinking of a very near-term call as a stock replacement strategy and you're rolling this, buying front month calls or God forbid weeklies every week or every month and rolling that over and over again, you're really doing this wrong. You really should focus on the longer term stuff if that's your goal, is to really be a surrogate or create a surrogate for a stock position. You're avoiding all of that exponential part of the time decay curve that you're getting with those near-term options. Just two little things I wanted to hit on there. I know, John, you're really excited to get in on this one as well. I know a lot of your clients, your customers over there at Sogo must call up looking for ways they could augment their stock trading using options, and I'm sure you spend a lot of your days walking people through a stock replacement strategy. So what are your thoughts on this strategy, this technique, and how it should be employed and some of the advantages and disadvantages?
Sure. I just want to touch on one thing first, and Dan brought up an excellent strategy that not many people think of, the writing the in-the-money put. The one thing I will mention is that there are some margin differences there. Buying the leap call, you're going to be paying whatever the premium is, whereas writing the in-the-money put, there is a a margin requirement there. And if I'm doing a in the money put on Netflix or one of these really high flying stocks, there's going to be a very, very high requirement. So, do your math, know what the margin requirements are for writing in the money put, and see which one is more cost effective. My customers do call here, and when we talk about stock replacement, there are some advantages and, of course, disadvantages. And Dan touched on some of these. The big advantage is for stock replacement is you're able to use the money that you save or the balance that you save by not owning stock and only owning the contracts. You can invest this money in other places. You also have, with the stock replacement, what they call deep stock protection. In other words, if Bank of America is $12 and you buy the January 2014 10 calls, you're basically you're protected, or you have no risk under $10. So that's one big advantage. There is also some disadvantages, of course, and Dan touched on these, and so did Mark. There is the time decay. You can hurt the option price as expiration nears. Remember, you're paying some premium to own these calls. And in the Bank of America case, the premium was about 50 cents, which is the approximate price of the puts also. And if you go back to our synthetics bootcamp, we explained that calls are puts, puts are calls, and why that is the case. And another disadvantage might be, guys, that there could be a wider bid-ask price in these long-term leap options and poor liquidity. So again, be careful. We have stated many times in the past that if the market is wide, try putting a limit order mid-market. Do not use a market order if you can avoid it. That way you get a better fill. And another thing also might be that if you own the deep in the money calls for replacement, and you don't have enough money in your account to take possession when the contract expires, then you're going to have to sell them. More commissions for Sogo trade, less money for you. So there are some advantages and disadvantages, but I am a big, big advocate of stock replacement. It's very cost efficient and asset allocation efficient.
Yes, I'm a big fan of stock replacement as well, and you brought up a number of great points there, John. That's one of the reasons why I traditionally don't lump the short put into the stock replacement, because one of the primary reasons you're buying the in-the-money call versus buying the stock is to free up some capital to do other things. If you, in turn, instead writing the put and you're tying up that same amount of capital, it is nice. You're collecting something, you're getting more bang for your buck than you would be if you just bought the stock outright, of course. So there are a lot of advantages there. You're taking advantage of time decay and all the other things we've talked about on this show in the past. But of course, from a capital efficiency thing, it is not as efficient as buying the call. And that really is the number one reason why people come to the stock replacement strategy. They own, let's say, you have your Amazons, your Google trading near 800 now is a great example. People don't want to come out and lay out $800 for each share of Google that they may want to purchase. So they look out there and maybe they see a deep in the money call that they want to trade that's trading $100 and maybe 50 or 80 or 200 or somewhere in that range. Some fraction of that price. They could then buy that. It'll have a near 100 delta depending on where they pick up that call, and they'll have a position that approximates quite a bit of the long potential of owning the underlying outright at a fraction of the cost. And that really is the attractive thing. And now Dan mentioned some alternative strategies for stock replacement. I want to bring one up again. We've touched on it a long time ago on the show, on our mistakes episode, I believe. But it's worth bringing up here again because for our listeners who are a little bit more savvy, this is a great way to utilize a stock replacement and get a little bit of extra bang for your buck. Now, we talked about covered calls in the past here on the show, which is, of course, a strategy where you just generate additional income. You essentially create your own dividend stream on the underlying of your choice. Very popular trade, very popular strategy with retail, with financial advisors, a lot of people who trade a lot of underlying with options. Now, the typical way to do that is you buy stock, you write you buy stock and you write an out of the money call, sometimes an in the money call, usually front month, sometimes weeklies. If you're doing it right the way we outline it, you're doing near term, not long term. But a good way to switch that up is to, instead of buying the stock and writing the near term call, you switch it up with a stock replacement. You buy a leap, an in the money leap call, something a much longer term, and then you proceed to write your near term, front month, perhaps weekly calls against that. And why would you do that? Well, remember we talked about the Greeks in this show. By swapping out a leap for the underlying, it gives you a much more preferable position from a Greek's perspective. You have a delta now which is variable. So remember, your delta on stock is 1. It goes up, it's 1. It goes down, it's 1. So as the underlying drops, which is your primary loss scenario in a covered call segment or a covered call position, it's going to move 1-to-1 with the underlying. As option with a delta, as the underlying decreases, that delta is going to decrease, lowering your rate of loss as the stock drops. Also, you now have a volatility component in that position as opposed to just stock, which doesn't have an option implied volatility component. So as the underlying drops, that implied volatility should increase, again, further offsetting some of your losses. So there are a lot of reasons to swap a long-term call for the underlying, not only the capital benefits you get from doing that. So if you're interested, you can just use a stock replacement as a way to save some money and trade multiple things with that capital, or you can get a little more savvy and write covered calls and generate some income. So stock replacement strategy, that is number one of our dual strategy scenario for you today of options with stock or in lieu of stock. Next, we're going to move on to a different strategy that has a different use, but is somewhat related to what we just talked about. This is indeed the stock repair strategy. Now, this is a strategy which is useful exactly in the scenarios that it sounds like the title alludes to. These are useful in scenarios we've all encountered where your underlying position, maybe you bought it at 15, now it's trading 10. The stock has moved against you a little bit. We've all done this. We've all said, oh, this is now a long-term buy for me, a long-term hold, as opposed to a near-term purchase of stock. And so what do you do in these types of situations? Where this is where the stock repair strategy comes in again. And Dan, once again, I know a lot of your clients, your mentees, come to you with these types of positions. Hey, Dan, I'm down X% in my XYZ underlying stock account. What can I do to make that money back faster? And you come to them and walk them through the stock repair strategy. So what do you typically tell your students when they come to you with those questions?
Indeed, I do. The stock repair strategy, under the right set of circumstances, can be a very, very useful, very, very practical repair strategy. Now, look, the thing is, you bought Enron at its high and, you waited until it's totally out of business. Sorry.
Have you been looking at my portfolio again, Dan? How dare you, sir?
Sometimes there's just nothing you can do about it. But the stock repair strategy is appropriate for a stock where you bought it and it fell in value 20 to 30%, and you think that over a couple or a few months, the stock can recoup half of those losses. The stock can retrace half of its loss. If those two criteria are in place, stock fell 20 to 30%, and you think the stock can recoup half of that in 2 to 6 months, you can use the stock repair strategy. And if it works out the way you think, you can get 100% of your loss indemnified to you. Here's how it works. Imagine XYZ stock fell from 100 to 70. What you would do is you would buy a call that expires in, 2 to 6 months, depends on your time horizon, with a 70 strike price. And we're going to assume that the time horizon is 3 months. So you're going to buy the at-the-money 3-month 70 strike calls, and then you're going to sell the 85 strike calls, but you're going to sell twice as many, okay? So what you're doing is you're overlaying what we call a 1x2 over your existing stock position. Stock fell from 100 to 70. It's sitting at 70 now. You're going to buy 170 strike call and sell 285 strike calls. All the options have 3 months till expiration. Now, here's why this is a potentially brilliant strategy, depending on the scenario. If the stock rises just halfway, not all the way back to 100, but from 70 to 85, you make back 100% of your loss. It's as if the stock never fell. It's as if you still own the stock at 100. The reason being because, of course, you're going to make your $15 back on your stock that you own as the stock rises back from 70 to 85. But that call that you bought, that's going to be like owning 100 shares of the stock. If you hold it all the way until expiration, you're going to make $15 back on that call, and the 2 calls that you sold would expire. Now, a couple assumptions here we're making. This is assuming that everything works out just perfectly, right? And it also assumes that the 2 calls you sold have about the same value as the 1 call you bought. So it's about a zero cost transaction. Take on no additional risk, but if the stock does retrace halfway, you get back 100% of your profit. Now, I've explained the ideal situation. Let's explain the situation where it's not ideal. Well, if the stock continues to fall, well, you're going to lose money on your stock, but you're not going to lose any extra money on the options because it didn't cost you anything. If the stock rises too much, maybe it rises back to 100 or more, maybe it rises to 120, you still only make what you lost back. This is like you're sitting there and you're like, oh my God, what did I do? And you pray to the options gods. If I can just make back what I lost, I swear to God, I'll never do that again. That's what this is for. You can't have it both ways. If the stock rallies way far back, you're only going to make back what you lost. So if you're good with all that, the stock repair strategy can be excellent.
Yeah, this is an attractive one for a lot of our listeners and a lot of retail customers, precisely because of what you outlined there, Dan. The initial outlay on top of their stock is usually very minimal to zero. Because you're doing that ratio, it allows you to essentially tack on a little bit extra to your stock at very minimal cost to you. And if it does go your way, you're actually looking pretty good. Of course, like Dan outlined, if the stock gaps up, you're not participating the whole way, just the part that till you wrote those calls, that strike price, then you're cut off from there. But it's an attractive strategy to a lot of people who have these, everyone's sitting on a 1 or 2 long-term holds in their portfolio. Maybe not now, the market's been rallying for quite a while. Maybe you had a chance to get out of those. But if you haven't, this might be a strategy that interests you. Now, John, of course, a lot of people calling up Sogo as well, looking to do options trades with stock. A lot of them probably have positions that are in the hole. They're looking to repair those. So walk our listeners through your thoughts on the stock replacement strategies and some of the pros and cons that you see with that position.
Sure. Dan stole a lot of my thunder. He did a great explanation.
That's why we give him the black hat. He's the thunder stealer.
Yeah, I'm just going to clean up a little bit. Not much to add, but we get a lot of customers that call up, as you said, when the stock goes against them, and they don't want to sell, and they say, John, what do I do? And there are different types of strategies you can employ. It's like the first one is the hold and pray. You just hold and pray, goes higher. That's not really a good strategy. The next one, which is even worse, is a double up strategy. And we all know as traders, to double up on a position, most times it's going to really be a bad situation. You don't want to double up on your position. So the stock repair is an excellent strategy. It requires little or no margin. It can cost zero to put on and maybe a small debit. And you really have a chance to recoup your losses. I mean, as Dan said in his explanation, it's best used for stocks that have fallen 10 to 40%. If a stock is down 80, 90%, this is not really a great strategy to use. But if a stock has fallen 10 to 40%, this is a great strategy to use. But you have to remember that you are repairing a position, and this takes time, like a broken arm. It takes time to heal. So most times you will need to use, a 3-month or longer option. And usually the greater the loss, the longer data options you may have to use. And one more thing I wanted to add was, as Dan said, I just want to reiterate, use this only if you expect the stock to rise slightly back. Because if it bounces back and goes through your initial purchase, you will not make any more money. The best you can do on this strategy is to break even. And Dan was 100% right. If you think it may rip higher and go through, this is not the strategy for you. But this is actually the downside of the strategy. The best you can do is break even. But it's a great strategy for the retail customer to employ when they want to try to recoup some of their losses.
Yes, indeed. And of course, if you are holding that stock position and you're worried about perhaps it retracing further and going back down aggressively, then this is not the strategy for you. Obviously, you really want to probably look at dumping that stock or hedging it with some of the strategies we've outlined in the past. Long puts, or perhaps a put spread, or perhaps a collar or something along those lines where you could profit and participate to the downside if you, for whatever reason, don't want to sell that position. So there you have it, listeners. 2 great ways to use options in conjunction with or sometimes in lieu of the underlying to make your investing and trading goals become reality. So if you haven't checked those out yet, then by all means, surf on over to sogotrade.com or shoot an email over to John and the team over there, and they'll walk you through how to do these strategies, and you can take advantage of Sogo's very low rates in order to do that. Sogotrade.com, check that out. They have a lot of great stuff here on how to do these exact strategies and much more. And of course, if you want much more hand-holding than that, then call up Dan or surf on over to markettaker.com, and he'll walk you through how to do these strategies in much more detail. But as for us, we're going to keep on rolling with the show right now and move on into our final segment, our mail call segment.
Mail call. Time to look at questions submitted by our listeners.
I always feel very patriotic whenever I hear that intro. I don't know why. It's probably just it just occurs to me whenever I hear that intro. This is, of course, the mail call segment. This is where you, the listener, get your chance to put on your hat of whatever color you prefer. Doesn't have to be black like Dan or white like mine or sky blue / magenta like John's. I'm gonna keep hitting on that, John, until you correct me, because it's just too fun. But this is, of course, the segment where you can join us on the show, and we have a couple of you doing just that. Going to kick things off with someone, M Higgins. I'm trying to remember. That sounds familiar. Wasn't there Mr. Higgins back on Magnum PI, the show? Wasn't that the little guy he lived with in the house? Wasn't that a Higgins too?
Maybe. You're reaching way back for that.
I am. That's an old 80s reference, but that name sounded familiar to me. Maybe he's writing to us on the show today. But Mr. Higgins, or M Higgins, writes, "My financial advisor is not a big fan of options." So that's strike one right there. Mr. Higgins writes, continues, "He keeps trying to steer me into annuities and life insurance policies instead." Yeah, I think you know where I'm going with this one. What do you guys think of those products as investment vehicles instead of using options? I think you can tell by Dan's response what his response is. Let me kick the ball off, and then I'll hand it off to you guys.
I think you should ask your financial advisor what he makes the most money on.
Yeah.
Just ask him.
There you go. I mean, that's a perfect place to start with this conversation. You know, we've hit on financial advisors a lot in the past. Maybe that should be a topic for a show down the road, is how to choose an option-savvy financial advisor. If you're just interested in that topic, listeners, by all means, we do have a show on the network for you, the Advisor's Option. You can check that out on the Options Insider Radio Network, or wherever your finer podcasts are purveyed. We'll have it out there. Just put out a new show today, actually, talking about some of these very concepts. But this question here from Mr. Higgins, or M Higgins, is a great one. We get a variation on this all the time, and this is Dan hit the nail on the head. Most of these advisors, have very little knowledge or understanding of options. So that's the first strike. You want to find an advisor who really has that specified knowledge, because, as you've seen from listening to this show, there's a lot of value that could bring to the table. An advisor who doesn't understand options can't do a stock repair strategy. He can't use stock to replace, or an option to replace stock in those scenarios. He can't construct a collar. He can't do a downside put spread. He can't generate income with covered calls. All the simple things we've outlined for you on the show, which are markedly beneficial to any retail trader or investor, he can't do. So that's strike number one, why you should get rid of this guy.
Tell him to take his time machine back to 1986.
The second part is, you're right. He's steering you into structured products and other things like this that's kind of perhaps not really his fault. I'm being charitable here. A lot of advisors have been taught, and they kind of just come up through this world of shifting all of your clients into these structured type products or into these annuities, things that proclaim to do all these things for you. And often they're not aware that a lot of these products, like annuities in particular, utilize quite a few derivatives in their construction. Otherwise, they couldn't really generate and guarantee all those returns. So you're getting a lot of options exposure, but they don't even realize it. And then B, life insurance, that's a whole other ball of wax in and of itself. I think my main synopsis to M Higgins here, if he is on Magnum PI, is to dump this advisor. Dan, it sounds like you have even more vocal opinions.
Yeah, I mean, look, man, I'm an options guy. This is an options show. I mean, some of this stuff doesn't really fit into my repertoire or anything. I am a believer in the idea of life insurance, depending on your lot in life. But annuities, I don't think you're going to find anybody who's a financial expert who's going to tell you that annuities are good. I mean, right? I don't know. Maybe I'm overstepping my boundaries here, but I remember one time when I was young, I mentioned to somebody who's pretty economically savvy about annuities, and he laughed at me. But I know that financial advisors make a lot of money on them.
That is another question you want to ask yourself is, of course, what does this guy get paid? What is his relationship with these companies? With a listed options contract, he's not getting paid by anybody. With an annuity, some of these other structured products, he could very well be getting paid, and usually is, to recommend those to you. So that also can be perhaps a conflict of interest if he doesn't implement them correctly. And you mentioned, Dan, who a reputable person can use annuities. I was at the Money Show here in Chicago last October, and of course, we all know how reputable that could be. And I'm saying that in a very, let's say, dubious tone. But I walked into their main hall there, and they had two platinum sponsors for their exhibit hall. One was TD Ameritrade, a firm we all know and respect for the most part, and then, of course, Stan the Annuity Man was the other platinum sponsor of the Money Show in Chicago. So someone clearly is out there doing annuities and selling them to the retail masses. Hopefully, if you're savvy enough to listen to this show, you're not one of those masses. John, do you ever get any calls about annuities or questions like this over at Sogo?
We don't get many calls, but I remember in about 1998, one of my good friends who was a Princeton-educated doctor invested $25,000 into an annuity with a pretty reputable, firm. And, of course, 1998, 99, 2000, near the top of the market. And within, I think, 2 or 3 years, I think it went down to zero. So I'm not a fan of annuities. We don't deal with them here. And I think you should just try to find someone an advisor who is more well-balanced.
Yes, all three of us agree. Again, we are an options-centric show, so we are perhaps a little bit biased. But if you want someone who's hawking annuities and life insurance policies to you, I don't know if you're really getting the best quality advisor. Next up, we have a Mr. Anonymous who wants to keep his name secret from all of the masses out there, lest you discover his true identity and all of his font of wisdom on the options market, I'm sure. He says, I've heard a number of options traders, including hosts on this network, use the term legging when referring to options trading. What does this term mean? Thanks for your help and for all of your fine options content. The Options Insider Radio Network is truly a unique options content destination for options traders. Well, Mr. Anonymous, who will go anonymous, thank you for writing in and for your kind words. We do endeavor to provide you, the listener, with a very unique place for options education and analysis and news and information, and of course, on the side, once in a while, a little bit of entertainment as well. And John, I can hear you smacking your lips back there, so why don't you kick things off here and walk Mr. Anonymous through legging and what that term means.
Well, we have gone over this many times in the past about wide markets, illiquid markets, and a lot of times it's even exacerbated when a customer sometimes enters a spread order. So legging means basically putting on a spread one leg at a time. One step or one leg at a time, legging. So what happens is that if you want to leg into a spread, that means you're going to buy one side of the spread first, and then you're going to either buy or sell the other side next. A great example is that we get calls all the time by customers saying, I have this trade I put on. It's a profitable trade. Should I sell? Should I hold? What should I do? And sometimes these traders that had this fortune dilemma of either taking profits or either letting their position ride in the hopes of capturing even more money. There's a third option they can do. They can leg into a spread. So, for example, if you purchase, let's say, the Netflix 170 calls yesterday, I think they were like $3. Okay, well, the stock went up a lot today. So now, instead of selling them, I think they were trading much higher. You could sell the actual April 175 calls at 375. So what you've done is you have legged into the Netflix April 175 call spread for actually a credit. So this is just one example of if you a third alternative to selling a position that maybe you don't want to sell. You can sometimes leg into positions, do them one leg at a time.
Dan, anything you'd like to add for Mr. Anonymous here on legging?
No, I mean, John, of course, explained very, very clearly. Just think of it that way, one leg at a time. You have two legs, right? So you I don't know. It's taking a step, I guess. You take a step with the first leg and then the second leg. I don't know. I'm just making this
You're
up.
reaching for that analogy, but it's,
I was totally reaching.
You're trying. I give you points, an E for effort, sir, if you will.
Can I just mention one more thing real quick? I know I spoke about it a lot already, but just be a little bit careful with legging. I mean, the real downside to legging is that you put the one side on, and then it goes terribly wrong against you. So just you have to be very, very proactive to get the other side off at some reasonable amount. I mean, there's a risk there that you put the one side on and then it goes horribly wrong, and now now your trade is all in tatters. So just be a little bit careful with the legging and make sure that you're maybe a little bit more advanced a trader before you try to leg into trades. That's what professional traders do, or they're more advanced retail traders.
Yes. Yeah, go ahead, Jed.
I was just going to add to that, John. Yeah, and one of the rules, of course, that we were all taught down on the trading floor is you should do the long leg first if you're going to leg, because the short leg has unlimited loss potential and, negative gamma. So, if you don't really have any control or any educated guess as to which is going to go wrong, but if one has to go wrong, you'd rather have the long leg go wrong than the short leg.
Dan the Thunder Stealer strikes again. I was just going to chime in with that little bit of wisdom there. Of course, that is the first thing you learn when you walk on the floor. We actually learned it a little bit differently. They say do the hard leg first, which is typically sometimes the long leg. But usually whichever component, usually is some component of a spread, unless they're very equidistant type contracts, usually is one's harder to get off than the other. So you definitely want to tackle that one usually first, get your price, get your level that you want there, and then you can do the easier one kind of whenever. So that was always how we did it, and the long leg is typically where you want to start in that type of scenario. But John is correct. You do want to reserve this. If you're not familiar with the term legging, you definitely should not be legging. You should definitely take your time. Go back, listen to all of our archived shows, become a little bit more familiar with the options market, options trading in general. Visit a site like mine, a free site, theoptionsinsider.com, where you can find a lot of great free educational material. When you're ready, call up a guy like Dan. He can give you some more advanced type of analysis. And then when you're ready to start actually trading, you call up John and you set up an account over there at Sogo, and you have your 1, 2, 3 step, and you're ready to go. But yes, legging an advanced strategy, but can be a great thing if you know a little bit more about options, how to get into and out of positions. It could be a very, very useful tool. All right, last up, we have a question from a listener who goes by the handle T-Biz. I gotta love those Twitter handles. He has a little bit of an interesting inside baseball type question, but I thought it'd be interesting for our listeners to discuss it here. He asks, what do the drill instructors think of the potential jumbo/max S&P contract? Now, what Mr. T-Biz is referring to, if you haven't been reading our website or listening to Dan's great show, the Options News Rundown, we talk about all the great options headlines. There's been a lot of back and forth in the options market lately. In fact, it goes back a couple of years now. Of course, a lot of you are familiar with the SPX contract, which is a very large institutionally focused contract that is listed exclusively on the Chicago Board Options Exchange. So if you want to trade that contract in any way, shape, or form, you have one place to go. That's to the CBOE. And a lot of the other exchanges obviously don't like that. It's a very potentially lucrative contract. And also a lot of customers don't like that. They don't like being forced to one place that can charge them exorbitant fees. The spreads can be a little wider, et cetera, et cetera. So there have been many attempts to go after that contract, many tilts at that windmill. Last year, the ISC, the International Securities Exchange, created essentially a 10x spider contract, which works out to be essentially an SPX contract. I think that contract got shot down very quickly by either the SEC or there might have been a local Chicago court who ruled that infringed on the patents and trademarks and licenses of the CBOE's contract. The Boston Options Exchange recently tried that again with another construction of spider contracts, essentially to become analogous or an approximation of the SPX contract. Essentially what this is a much larger institutional size contract. And it looks like from the early goings here that this contract may actually have a chance of being approved. So what this will do is now allow this one contract, this SPX, that has essentially been locked to one exchange forever since its inception, to now be multiply listed on multiple exchanges if this is approved, and will allow retail traders, but not the problem with this is not a lot of retail can afford to trade SPX. It's a very large, very hefty contract. This is primarily for the institutional listeners out there, but if there are some of you floating around in the retail space who have a little bit larger accounts, have a large portfolio. Perhaps you like to hedge with SPY puts or do SPY collars or what have you, but SPY is a little bit too small for you. You have to do too many contracts all the time to hedge your portfolio. You may want to think about an SPX or an SPX type contract, and that's where this could potentially help you. So my 2 cents on this is that this sounds like this new construction that Box is working with. I'm not familiar with the exact specifics as why this contract is preferable than all the others that have come before it, but apparently it is. I haven't read all the detailed filings yet. This could potentially be the one to finally allow everyone, retail, institutional, to trade SPX without having to trade that contract in that pit, deal with the wide spreads, deal with the large fees, and all the other problems associated with that. Now, John, you guys said you do a lot of retail business, a lot of international retail business. Do you have a lot of overlap in SPX or interest in SPX over there?
Yeah, we don't have we have very limited interest, and I would think this would be institutional demand only. Very few retail customers, I think. This is the reverse mini. I mean, the minis are a phenomenal idea. The 1/10, but the jumbo contract, I think it would be more institutionally based. And as you said in the past, they tried a few cracks at this. They've got shot down, and now it's come through a new iteration, and we'll see what happens. But you know what? Maybe it'll go through, and maybe we will get some customers demanding it because it'll only be one contract versus 10. We'll see.
Dan, any of your customers come in and like to use SPX or anything like that?
Yeah, I mean, some of them do, and I talk a lot about SPX versus all the other derivations of what's tradable as far as the S&P 500 goes. So I'm sure I'll have some customers who it's totally appropriate for.
Yeah, again, this isn't really a product aimed at the core audience of this program, the very basic retail options trader, but it's one that as you progress in the options spectrum, and certainly some of you who are, like I said, perhaps not that option savvy, but could have larger portfolios, certainly some of the financial advisors out there who manage large portfolios, this would certainly appeal to them because it's just an easier way to hedge and to construct collars and things like that without having to do the 10x number of contracts that is required in the Spider option. So great question there, Mr. T-Biz, and thanks to all of you who joined us here on the mail call segment. If you'd like to play your part and join us on a future episode and have your question answered by the drill instructor squad here, then by all means surf on over to theoptionsinsider.com. You can leave us a comment there on the website or on these episodes. We'll find those and route those to the appropriate show. You can, of course, shoot us an email, questions@theoptionsinsider.com, or you can find us on Twitter or find us on Facebook. A lot of great ways to get in touch with us here on the Options Bootcamp program. But unfortunately, that's all the time we have for this episode. And before we go, I'd like to check in with each of my fellow drill instructors to see what they have going on that may interest you, the listener. Starting with you, John, what is coming up in the ever-expanding, ever-fascinating world of SogoTrade.com?
Well, we are increasing our multi-leg capability in the next few weeks to maximize the margin available to our customers. It's what they call an optimizer, and I've been working on it for about 2 years with the IT department, and we're hoping to roll that out. Just basically a more advanced way to do strategy-based margins. So that's pretty exciting. Of course, we have the Sogo Trade blog, which is brand new on our website. I'm going to be trying to pen some more articles for the Option Insider. And we have our application-based option platform rolling out sometime soon. We're just waiting to get through some regulatory red tape. And when we get it approved, that should be out in the next maybe month or two. So that's very exciting.
How timely of you to get your multi-leg capability up and running right when we're talking about legs. It's perfect timing on your part there, John. It's like you planned it 2 years ago. You knew this question was coming in about legs.
Absolutely.
And Dan, what is coming up in the land of market taker mentoring?
Oh, I've got a couple of good things in the works, but they're kind of top secret right now.
Give us a hint, Mr. Black Hat.
There might perhaps be a little bit of a community thing going on here with Market Taker that I'll be able to let you guys know about probably next show. So stay tuned for that. And
is that your annual Bacchanal and Toga party I've heard so much about?
Oh, yeah. You coming this year again?
Wouldn't miss it, sir.
All right, my friend.
Well, we'll look forward then to these upcoming super secret activities and plans from the boys over at Market Taker Mentoring. But before we go, I do want to mention, of course, like I did at the top of the show, if you like what we talk about here and you like listening to Dan's voice, and who doesn't, then by all means tune on into the Options News Rundown. You can get a little dose of Dan every day in your life, and really, who doesn't need some of that? And last, but certainly not least, now speaking of Dan, he'll be at this one too. Dan's all over our stuff these days. Of course, if you are interested in what we talk about on this show and perhaps taking it to the next level, you visited the Options Insider and seen a lot of our unusual activity alerts and that type of content we have on the show, or on the website, I should say. We have an event just for you. If you're going to be in Chicago, that's important. This is for Chicago listeners only. If people are going to be in the area on May 15th, we have a great event, our premier live event, our premier unusual activity forum, going to be held at the Chicago Board Options Exchange on May 15th. Come on down. You get to see myself, you get to see Dan, a bunch of other great speakers talking about unusual activity, how to find it, how to analyze it, and how to, most importantly, trade profitably from it without encountering all of the many obstacles and roadblocks you typically can when first diving into that sort of activity. Of course, we get a lot of great bonuses for you when you sign up. Floor tour of the exchange, all kinds of great stuff. A free month of Dan's group coaching. That alone is not enough to get you to sign up. I don't know what is. A lot of great stuff. Surf on over to theoptionsinsider.com/events to find out more about the event and to register for yourself. And on behalf of Dan and John and myself, we want to thank all of you out there in the listening audience for downloading and streaming and subscribing to this program and making it such a success. And we'll see you next time right here on Options Bootcamp.
Options Bootcamp is brought to you by Sogo Trade, an extraordinary value in online trading. Why pay more for the same trade when Sogo Trade can deliver for less? Options commissions are just $5 per ticket and 50 cents per contract, and just $3 for stock and ETF trades. Open a new account today and receive 100 free trades. Visit www.sogotrade.com to learn more about all our free trading tools, educational resources, and other resources available to you to enhance your trading experience. Remember, options involve risk and are not suitable for all investors. For more information, please read the characteristics and risks of standardized options available at www.sogotrade.com. Options Bootcamp is produced by the Options Insider, Inc. All rights reserved.
The preceding program was a presentation of the Options Insider Radio Network. For more programs, visit www.theoptionsinsider.com/radio or search for Options Insider Radio in iTunes.